Let me ask you something directly. If the Social Security Administration quietly changed a rule that permanently reduced the amount of money going into your bank account every single month, would you even know? Would someone call you? Would you get a letter? Would SSA send you a personal explanation breaking down exactly what changed and why your check is different? The answer is no. They never do. They change the policy, they update the website, and they expect you to already know. And the people who don't know, the ones who miss the deadline, make the wrong claiming decision, or never think to check their records, those people lose money they are legally entitled to, and in most cases, they lose it permanently. There is no going back. There is no appeals process that fixes a bad claiming decision after the fact. There is no refund for years of Medicare overcharges you never disputed. And there is no way to correct your earnings record once you've already claimed and the clock has stopped. That is what this video is about, because right now in 2026, there are real changes and real deadlines affecting real people across every age group, and the majority of those people have no idea any of this is happening. I'm going to break it all down by birth year group because the SSA does not apply the same rules to everyone. Your full retirement age is different. Your benefit calculation is different, your claiming options are different, and the mistakes that can cost you are different depending on exactly when you were born. So find your group, pay close attention to what applies to you specifically, and by the end of this video, you'll know exactly what to check and exactly what to do about it. Before we get into the groups, if you are not subscribed to this channel, please do that right now and turn on the bell notification. And I want to explain why that actually matters and isn't just something I say. The Social Security rules change constantly. Claiming thresholds, earnings limits, Medicare premiums, IRMAA brackets, overpayment policies, survivor benefit rules, these things shift every single year, sometimes mid-year, and when they shift, the SSA does not notify you personally. They update their internal systems and move on. What I do on this channel is take those changes, translate them into plain language, and explain exactly what they mean for your specific situation, before the deadlines pass and before the mistakes are already locked in. Every group I'm covering today has something specific happening in 2026 that directly affects their monthly benefit, their Medicare costs, or their long-term financial picture. The people subscribed here find out in time to do something about it. The ones who aren't subscribed tend to find out after the wrong decision, after the deadline, after the money is already gone and can't be recovered. Hit subscribe, turn on that bell, and let's get into the groups. If you were born between 1943 and 1954, you are somewhere between 72 and 83 years old right now, and you have been receiving Social Security for a while. Your full retirement age was 66. And here is the thing. Most people in this group assume that once you're collecting, there's nothing left to review. There's nothing to check, nothing to update, nothing that could change. That assumption is costing some of you real money every single month, and it has been costing you for years. The first and most important thing people in this group need to look at is whether they are collecting the right benefit entirely. This is not a small issue. A significant number of widows and widowers in this age range are collecting their own retirement benefit when they would actually receive more money by switching to their late spouse's record. The survivor benefit for a widow or widower can be up to 100% of what the deceased spouse was receiving at the time of their death. And in many cases, especially when the deceased spouse had a higher lifetime earnings history, that survivor benefit is substantially more than what the surviving spouse receives on their own retirement record. Here's why this gets missed so often. When a spouse passes away, SSA does not automatically put the survivor on the higher benefit. You have to ask. You have to call SSA, request that they pull both figures, and ask them directly which benefit pays more. If you lost a spouse at any point in the last decade, and you have been collecting on your own record without ever having that conversation with SSA, there is a real and meaningful possibility that you have been leaving money on the table every single month since then. That money does not come back to you retroactively. But going forward, you can get it corrected. Call SSA at 1-800-77-21213 and specifically ask them to compare your retirement benefit against your survivor benefit and place you on whichever is higher. It is a free phone call, and it could change your monthly income significantly. The second issue for this group is Medicare, and specifically something called an IRMAA surcharge. IRMAA stands for Income-Related Monthly Adjustment Amount. What it means in plain terms is that if your reported income from 2 years ago was above certain thresholds, Medicare charges you extra on top of your standard Part B premium. In 2026, the standard Part B premium is $185 a month, but depending on your income level from 2024, you could be paying anywhere from $70 to nearly $500 more than that every single month. The problem is that Medicare uses your income from 2 years back, which means if you had a one-time income spike in 2024, a property sale, a large Roth conversion, an inheritance, a one-time distribution from a retirement account, you may be getting penalized for income you will never have again. The income is gone, the event won't repeat, but Medicare is still charging you as if you're earning at that elevated level. The appeal form is the SSA 44. It exists specifically for this situation. If you have experienced what SSA calls a life-changing event, retirement, divorce, death of a spouse, or a significant one-time income event, you can submit that form with supporting documentation and request that Medicare use your current, lower income instead of the 2-year-old figure they have on file. If you are currently paying more than $185 a month for Medicare Part B, and you don't know exactly why, that is worth a phone call and possibly worth filing that form. The money that gets refunded if you succeed adds up quickly. We're potentially talking hundreds of dollars a month going back into your pocket for the rest of the year and into next year's premium calculation as well. If you were born between 1955 and 1959, you are somewhere between 67 and 71 years old right now. And this is the most critical group in all of 2026. Here is why. The rules are literally different for every single birth year in this range, and almost nobody knows their specific number. People in this group constantly think their full retirement age is either 66 or 67, and they are wrong in both directions. Your full retirement age is somewhere in between, and the exact month matters enormously. Here's the breakdown you need to know. If you were born in 1955, your full retirement age is 66 years and 2 months. If you were born in 1956, it is 66 years and 4 months. If you were born in 1957, it is 66 years and 6 months. If you were born in 1958, it is 66 years and 8 months. And if you were born in 1959, it is 66 years and 10 months. That is your specific number. Not 66, not 67. Your actual full retirement age down to the exact month of your birth year. Write it down, because everything else about your Social Security situation, every percentage, every penalty, every bonus, is calculated relative to that precise date. Why does this matter so much right now in 2026? Because people in this group are making or have very recently made their claiming decision, and that decision is permanent. If you claimed at 62 with a full retirement age of 66 and 6 months, meaning you were born in 1957, your monthly benefit was permanently reduced by approximately 25.8%. On a benefit of $2,000 a month, that is $516 less every single month for the rest of your life. Over 20 years of retirement, that is more than $123,000 in cumulative losses compared to what you would have received by waiting. SSA does not warn you about this in a meaningful way before you sign the application. They ask if you understand your benefit will be reduced. You say yes, you sign, and that reduced number becomes your permanent benefit amount. It does not adjust later. It does not correct itself. It stays reduced forever. Now, for people in this group who have not yet claimed, and there are people born in 1955, 1956, and 1957 who are past their full retirement age and still have not filed, every single month you continue to delay past your full retirement age earns you an additional 0.2% more permanently. That compounds out to roughly 8% more per year. Between your full retirement age and age 70, depending on your exact birth year, you can accumulate anywhere from 24% to 32% more in your monthly benefit for the rest of your life. On that same $2,000 benefit, that is potentially $640 more every single month permanently, just for waiting. The break-even calculation on that delay is typically around 12 years, meaning if you live past your early 80s, and most people today do, waiting to claim is the mathematically superior choice in the majority of cases. There is also a rule in this group that catches people off guard every single year, and it is called the earnings test. If you are currently working and collecting Social Security before you have reached your full retirement age, SSA will withhold part of your benefit if your earned income exceeds a certain threshold. In 2026, that threshold is $23,400. For every $2 you earn above that limit, SSA withholds $1 from your Social Security benefit. So if you are earning $43,400 in wages this year while collecting early Social Security, SSA withholds $10,000 from your benefits across the year. The money is not permanently gone. It gets credited back to your record and increases your monthly benefit once you reach full retirement age. But if you do not know this rule exists, having your checks reduced or temporarily stopped with no explanation feels like something has gone seriously wrong. Know the limit, know how it works, and plan accordingly. If you were born between 1960 and 1965, you are between 61 and 66 years old right now. Your full retirement age is exactly 67, and the most important thing for every single person in this group is understanding, in real dollar terms, not percentages, what it means to claim before that age. The maximum early claiming reduction for someone in this group is 30%. If you file for Social Security at 62 with a full retirement age of 67, your monthly benefit is permanently cut by 30%. On a $2,000 monthly benefit, that is $600 less every month forever. Over a 20-year retirement, that is $144,000 in cumulative income that you gave up by not waiting. That number needs to sit with you. $144,000. Not a rounding error, not a minor difference. A life-changing sum of money that comes down to one decision that cannot be undone. And SSA will process that early application without stopping to make sure you truly understand what you are walking away from. They will ask if you acknowledge the reduction. You say yes, the application goes through, and the reduced amount becomes your number for life. What most people in this group are not aware of is a claiming option on the other end. What happens if you wait past 67? If you apply for Social Security after reaching your full retirement age of 67, you have the option to request up to 6 months of retroactive payments. SSA pays you as if you had actually applied up to 6 months earlier, issuing a lump sum for those back months with your first check. On a $2,000 monthly benefit, that is a potential one-time payment of up to $12,000 arriving with your very first deposit. The trade-off is that your ongoing monthly benefit is slightly lower because your start date is moved back. But the option exists, it is completely legitimate, and the vast majority of people who qualify for it never ask about it because nobody told them it was available. If you are approaching 67 or already past it and haven't claimed yet, ask SSA specifically about retroactive benefits before you file. The other thing people in this group need to do right now, while it still matters and while you still have time to fix anything, is verify your earnings record. Go to ssa.gov and create a My Social Security account if you don't already have one. Pull up your Social Security statement and go through the earnings listed for every year you worked, from your very first job to the most recent. Compare those numbers against your own records, old tax returns, W-2s, any documentation you still have. What you are looking for is any year where the earnings SSA has on file don't match what you actually earned. An employer who submitted wrong payroll data, a year of self-employment income that never got recorded correctly, a job from the 1990s at a company that has since closed, whose records may have been transferred inaccurately or not at all. Each of those errors, left uncorrected, reduces your monthly Social Security benefit by approximately $100. Find them now while the documentation is still findable and while the correction process is free. If you were born in 1966 or later, you are 60 or younger right now. You are not close to claiming Social Security, and I know what some of you are thinking. You're thinking, this doesn't apply to you yet, that Social Security is a problem for future you, that there is plenty of time to figure this out later. But here is the thing. There are specific actions you can only take right now while the window is still open that will directly determine how much money you receive every month for the rest of your retirement, and some of those windows are closing quietly without any warning. Your full retirement age is 67. Claiming at 62 means a 30% permanent reduction, the same as Group 3. Waiting until 70 means earning delayed retirement credits that add up to approximately 24% more than your full benefit, permanently. Those numbers are fixed by law and they are not going to change in your favor. But what is not fixed yet is whether your earnings record is accurate. And for people in this age group, that is the most important thing you can address right now. The Social Security Administration has been recording your payroll data since your very first job. Every summer job, every part-time position, every full-time role, every period of self-employment. That data came from your employers, and it came from payroll systems that were not always reliable, especially in the 1980s and 1990s when much of this was processed manually. Every year there was an opportunity for something to go wrong, a transposition error in a wage amount, a year where a job ended and the final payroll never got submitted, a period of freelance income that was never reported to SSA because no one told you it needed to be, a stint at a company that later went bankrupt, whose employment records were never properly transferred. Each one of those errors, left uncorrected, reduces your eventual monthly Social Security benefit by approximately $100 per affected year. If you have 3 or 4 years with inaccurate or missing earnings on your record, that could be $300 to $400 less per month in retirement, and you would never know why unless you checked. The fix is straightforward. Go to ssa.gov, create a My Social Security account, open your statement, and compare the earnings listed for each year against your own records. W-2s, old tax returns, pay stubs, whatever you have access to. If you find a discrepancy, you file a request for correction of earnings record with your supporting documentation. SSA processes the correction, updates your record, and your future benefit reflects the accurate amount. Here is why doing this now, and not in 5 or 10 years, matters so much. Documentation disappears, Tax returns get thrown out. Old employers go out of business. Digital payroll records from the 1980s may not exist in retrievable form anymore. Every year you wait makes the paperwork harder to find and the correction harder to process. Doing it now, while you still have the documentation and while the error is recent enough to verify, costs you nothing. Waiting until you're 2 years from claiming and suddenly scrambling to find a W-2 from 1994 is an entirely different experience, and it might be too late by then. Here is everything in one place, organized by group, so you know exactly what to do. If you were born between 1943 and 1954, your immediate priority is checking whether you are on the right benefit. If you are a widow or widower and you have never asked SSA to compare your retirement benefit against your survivor benefit, make that call this week. The number is 1-800-772-1213. Your second priority is your Medicare Part B premium. If you are paying more than $185 a month and you are not sure why, ask about IRMAA and look into the SSA 44 appeal form, especially if you had a one-time income event in the past 2 years that is not representative of your ongoing income. If you were born between 1955 and 1959, your single most important task is knowing your exact full retirement age down to the specific month. Not 66, not 67, your month. Then understand what the permanent consequences of your claiming decision look like in actual dollar amounts. And if you have delayed past your full retirement age, calculate what you stand to gain by waiting until 70 versus filing now. If you are currently working and collecting before your full retirement age, know the 2026 earnings test limit of $23,400 and plan your income accordingly. If you were born between 1960 and 1965, you need to have a clear and honest conversation with yourself about what a 30% permanent reduction means in your specific situation before you make any claiming decision. Put the actual dollar number on paper, then look into the retroactive lump sum option if you are at or past 67 and haven't claimed yet. And check your earnings record at ssa.gov today, not this month, today, while you still have time to fix anything you find. If you were born in 1966 or later, your action item is the same. Open ssa.gov, create your My Social Security account, pull your statement, and verify your earnings record year by year going back to your very first job. Do it while the documentation exists, while corrections are free, and while there is still time to make sure your future benefit reflects every dollar you ever earned and paid taxes on. Subscribe to this channel and share this video with someone in your life who belongs to one of these groups, because the people who find out about these things in time can act on them. The ones who don't find out until it's too late can't.